Welcome, everyone. It's the cryptolark. Very excited to have back on the show Kane from Synthetix. He's the founder of Synthetix and has been doing some amazing things in the decentralized finance space. Kane, how's it going?
Good, good. Thanks for having me.
Thanks for coming on again. Now, I just want to mention to everyone out there in the audience before we really dig into this chat that this is not a sponsored chat. I'm really excited that Kane was able to take some time out of his day to come here and talk about decentralized finance because he's right at the forefront of this. Synthetix is one of the biggest decentralized finance platforms out there. And so I'm really keen to hear some of the insights on decentralized finance. We're going to be talking about all kinds of stuff, the risks of decentralized finance, gaming oracles, synthetic assets, Ethereum 2.0, how big can Ethereum get over time, that and a lot more. So make sure to stick around. There's going to be a lot of awesome value in this conversation. But I want to start off because I've seen this I guess kind of topic come up quite a bit with Bitcoin. Oh, Bitcoin is going to do decentralized finance one of these days, some point in the future. Has Bitcoin completely lost the decentralized finance race?
I mean, I don't think it was ever really in the decentralized finance race, right? Other than, from a kind of payment network perspective, right? So, the idea of Bitcoin was very much to be this payment mechanism and a method of, exchanging value over the internet, right? And I think what we've seen with Ethereum is that having programmable money, right, that can be kind of put into smart contracts and engineered is very powerful, right? And that was the kind of genesis of Ethereum, was to create this mechanism to process any kind of payment, any kind of transaction, and have this generalized computing platform. And so I think it took a while for us to get to the point where DeFi could emerge. It wasn't until like late 2018. But I don't think Bitcoin has the tooling to kind of even approach the level of sort of generalized computing that Ethereum has. So I don't think it was ever really in the race. It's kind of the store of gold, store of value, gold narrative, right? So
I've always felt like Bitcoin's just off kind of doing its own thing and that it doesn't need, this is what I always thought, Bitcoin doesn't need all this DeFi stuff. Let Ethereum do that and then they can work together to make, a decentralized financial world together, not separate, but together.
Yeah, absolutely. And I mean, look, I think Bitcoin is being brought into Ethereum, slowly. There's a lot of projects that are looking at, tokenizing Bitcoin. Synthetix has synthetic Bitcoin. You've got wrapped Bitcoin. There's TBTC. There's a number of different implementations that will bring Bitcoin onto Ethereum. And I think that, as we've seen with the stable coins being pulled into Ethereum, I think that there will be a lot of value for allowing Bitcoin to kind of participate in this DeFi ecosystem. So I think that's the way that they'll kind of emerge and meld together potentially.
Now, there was this recent exploit that happened on BZX, and I know that I think synthetic USD might have been used for a small part of that. You can break some of that down if you want for us, but really I wanted to dig in on what do you see right now as being the biggest risks to decentralized finance. I think what happened on BZX really underlined for a lot of people, like, oh, it's not just totally bug-free and safe and everything's fine. Like, this is still new technology, a lot of this stuff, and these are new platforms, and bugs will happen and bugs will be worked out. So as someone at the forefront of the industry, what are the biggest risks to DeFi in your opinion?
I mean, you said it yourself, right? This is very early, very experimental. It's not just the bugs, right? Because the bugs are, always something that can kind of get you, right? It doesn't matter how many audits you have, how many different people have reviewed the code. Things can sit there for sometimes years, right? You look at something like Heartbleed, right? One of the most used things, pieces of infrastructure in the internet, and sat there for years and years and years before, people realized that this is a problem. So it's almost impossible to say that there's no bugs in a system, and it doesn't matter how long it's used for. But I think there's another element or another component that we need to be wary of, which is that we don't necessarily know all the implications of how these systems can be used together. Right? Even within the kind of DeFi ecosystem, it's all connected together, right? And so, look at the BZX, issue. It came from, a connection to Kyber, which was being used as an oracle, and then a connection to SUSD, where there was a ton of liquidity that could be pulled out. And so there's implications of these systems that you really need to kind of almost see play out empirically, right? It's hard to reason about. So I think one of the biggest risks is that as new systems are added, there's additional complexity in surface area that arises, and it's really hard to kind of reason about what the impacts are. So, it's a very high risk experimental place that you should be very wary of, right? And if you look at things like yields and the ROI that you can get out of participating in DeFi, there's a reason why it's so high. If it was kind of in line with holding bonds or whatever, then it would be a different perspective. But there's risk there if the yield is much higher than some other asset you can hold.
That's it. I think that's a really good thing to underline, is that this is part of the reason why we do see such outstanding rates sometimes in the decentralized finance space. I think the other day BZX was offering like 41% for Ethereum annualized percentage.
Yes.
Now, obviously that's changed drastically since then, but they really want, hey, people come back in. Things happen. We understand that, but come back in. It's okay now. We fixed those exploits, hopefully, and
Yeah, there's risk there, right? Like, did they, is there an issue, whatever? Could something else happen? And so, you're weighing up that risk of a platform that, is obviously going to be higher risk than, say, Compound, right? If Compound's offering you 1% for ETH and BZX is offering 40%, and some of it can just be sentiment, right? It can be the sentiment of the market says, well, I'm worried about this, even if there's no particular issue to be concerned about. There's just an overall, the market's pricing in that risk.
I got something here. I liked what you said the other day. I pulled this from your Twitter. So it was every DeFi platform must adapt or be attacked. I kind of like this idea because you're out there just really, most of the decentralized finance platforms we have right now, you're literally cutting the trail for everyone that's going to come behind you right now.
Yeah, it's just the reality, right? If you're building a DeFi platform, there's kind of two states. There's the state where no one cares about it and it's not seen as valuable, and then there's the state where it's being attacked, right? As soon as it gains any, people only attack something that they think there's value in, right? And so Synthetix for a long time was sitting there and no one attacked it because they didn't see value in it, right? And then all of a sudden we kind of hit this inflection point where people said, well, it looks like there's real money here. And then they started trying to exploit it. We had front running issues. We had, Oracle exploits, all kinds of different attack vectors. So I think that, any DeFi platform that gets traction is going to suffer some level of, attempted exploit, right? Whether or not a system is actually exploited or not is sort of up to the project itself to kind of make sure it's as robust as possible. But people will definitely try to attack you. There's no question that will happen.
That must have been a really weird moment for you when this started happening, because on the one hand, it's like, oh my God, we're being attacked. This is terrible. At the same time, it's like, we've made it. Yes.
Yes. Yeah, exactly. Yeah. We're real, right? Like once, you get scammers and attackers and hackers and people coming after you, then, in a very real sense, you become valuable. And so if you don't have that, then, there's probably something wrong. But it is also, it's not fun to be attacked constantly, right? So it's something we have to deal with.
How do you stop front running in this kind of situation? I'm quite curious to see how you guys have been approaching this problem.
Slowly, I think, is unfortunately the answer, right? Front running emerged in around July of last year, so July of 2019, maybe a little bit earlier. People were starting to kind of test out the system, see where the potential gaps were, and we tried multiple different approaches to resolve this. We eventually came to a kind of solution which is called fee reclamation, where essentially we force the person after they've traded to wait for a certain amount of time before that trade is released, to allow the Oracle latency to kind of catch up with the market, right? And so that's the way that we've approached it. There's a UX trade-off, obviously. The user experience is not ideal there, but we think that the trade-off is worth the security for the system. So it's been working pretty well. It's been in production now for about a month, and it seems to be holding up fairly well.
Nice. I guess the idea of gaming oracles must be a pretty big worry for basically all these platforms, that you're so reliant on this data to come in from multiple places. And so I guess, trying to stop the front running is one way of that. But what are some other ways that the gaming of oracles can be mitigated?
I mean, we've migrated or in the process of migrating from our own centralized Oracle to Chainlink, right? So that's one way. So that's what
you just made everyone's day. Everyone's made crazy in the comment section about it. Everything else you said is relevant.
That's good. So we've migrated to Chainlink, right? And what that's done is allowed us to kind of hand over the responsibility for data integrity to Chainlink, right? Which is their sole focus. That's all they do all day long. They're worried about all kinds of issues in terms of exploits and attack surface and what have you. And it's just going to be a much more robust system than if you roll your own Oracle. I was on a podcast with Sergey a few weeks ago, and we were sort of talking about this. When we launched Synthetix, or back in the Haven days, there wasn't a live decentralized Oracle on mainnet, right? So we were forced to roll our own, but now we're in a lucky position as a DeFi community where you do have these decentralized oracles that are available and can be connected up. So it's definitely a much better place. The tooling is much better than it was back 2 years ago.
Nice. Now, one thing we've seen be quite a topic of conversation recently is flash loans. Now, this is kind of everything we're talking about here as well, kind of all plays into this. So for anyone out there who doesn't know, can you just say what a flash loan is and why it's become such an issue, and what the implications of flash loans are, and why they're exciting too?
Flash loans allow someone to borrow almost unlimited amount of money, right? And they can borrow that money under the condition that they repay it within a single transaction. So one of the nice properties of Ethereum is you can chain together these transactions, have these atomic transactions where a bunch of different contract calls are all chained together to get this sort of long curve of transactions. And you can see that in some transactions where there's 50, 100 different actions that are taken throughout the transaction. And so if you can borrow 5,000 ETH, let's say, from like an Aave flash lending pool, right? And you can do something and then pay back that 5,000 ETH, you can get the 5,000 ETH, right? That's the only condition. You have to pay back the 5,000 ETH, right? So you borrow 5,000 ETH, you take the ETH and you drop it into a contract, and then you go do something else with a different contract and then a different contract. And if at the end 5,001 ETH comes out, you can keep the 1 ETH and you pay back the 5,000 ETH and you go on your merry way. And it's cool for a whole bunch of reasons, right? One of the ways that it's useful is you can use that ETH to potentially restructure a loan, right? So let's say you have a CDP open on Maker and you want to move it to Compound or vice versa. You can borrow ETH, repay the loan, move the collateral, redeposit it, reborrow it, and then pay back the loan at the end of the transaction. And you don't need to come up with the actual ETH to rebalance the loans while you kind of move stuff around. So that's just, there's many examples of why it's useful. If you are a hacker who's trying to exploit a contract, it is obviously very useful, right? Because, basically any exploit that you can find, you don't need to have the capital to be able to attack it. And I think that, where my tweet about, you basically need to adapt or be attacked, right? For DeFi protocols was kind of getting to this point that one of the things that I think our threat model sort of assumed was it's pretty hard to get $15,000, $20,000, $30,000, 30,000 ETH into a wallet and have it be anonymous, right? Mm-hmm. It's probably going to have touched some KYC or whatever, right? And so, there was this idea of, okay, let's say someone has 30,000 ETH and therefore they can do some bad thing, right? How much of a deterrent is it that they probably are going to be not anonymous, right? Mm-hmm. And now that threat is very different because someone can get 30,000 ETH and remain totally anonymous because they're borrowing it from DYDX or Aave or whatever out of a lending pool and they're repaying it in a single transaction. No one knows who they are. And so basically we need to kind of update our threat model for what is the thing that someone could do if they could have 50,000 ETH or 100,000 ETH anonymously and go and do whatever they want.
You have to give it to these guys. They are obviously very, very clever. If only they spent their time doing something more productive. But nevertheless, it really is just showcasing what is actually possible with the technology, which is obviously very exciting for a whole range of reasons. And yes, people will try to exploit these things when it happens. Now, one thing I hear a lot about decentralized finance is just how decentralized is decentralized finance. I feel like there's a lot of misconceptions about what decentralized finance is and what it isn't. Can you speak a little bit on that?
So, I think there's kind of a spectrum, right, of decentralization, and there's various different aspects of any given project, right, that need to be factored in. So, to take Synthetix as an example, we have some aspects of the project that are fairly decentralized in terms of like our governance and upgrade process, et cetera. But those are offset by the fact that we have a contract architecture that is 100% mutable, right? Like it can be changed by 4 of 7 people who control our protocol DAO, and so if those people within the protocol DAO decide to make a change, right? They could theoretically arbitrarily change the protocol, even against the wishes of the token holders, right? And that's a problem for very obvious reasons, right? Now, all of the people in the protocol DAO have significant stake in SNX tokens, right? And so it would be sort of counterproductive or not ideal for those people to blow up the protocol for the sake of making some arbitrary change to the contracts, right? So there is this kind of credible threat, in terms of skin in the game, that they're all token holders and they probably don't want to blow up the project, but that's not ideal. Right? That's not the ideal state that we want. We actually want something that is sort of enforceable on chain to protect the token holders. And the way that we're thinking about this is we will essentially have a set of contracts that will allow the protocol DAO to propose a protocol upgrade, and then the token holders will be able to veto it. Right? So there'll be a period where people can inspect it and see what the changes are, and they can say, okay, well, we like those changes or we don't like those changes. And if we don't like them, we can veto them. And that gives token holders some kind of protection or security that, the contracts won't be arbitrarily upgraded. It's not in place yet. It's something that will be put in place. And I just feel like to a certain extent, we're in, as I mentioned with the oracles, right? We're in a kind of similar phase where you kind of need to solve this problem yourself a little bit. There are things like Aragon, there are, Gnosis safes and multi-sigs and stuff, but I don't think we have a really good set of tools or patterns to use to kind of solve these problems. And so everyone's kind of going about it in their own ways at the moment. But I think over the next 6 to 12 months, we will start to kind of develop some pretty clear systems and norms about how these things are managed. And there's no question it has not been ideal the way that we've done this, but it's been a trade-off that we've made for our ability to kind of iterate quickly. But it does require a level of trust in the community and token holders. And ideally, we want to remove that trust over time and replace it with something that is much less trusted. And I think that's how we can kind of get to a place where the protocol is much more decentralized. And all the different projects have these different trade-offs that exist, right? There's issues with what the data integrity is in terms of oracles. What oracles are they using? What functions do they have the ability? Can they shut down the contracts? Can they change the oracle destinations? Like, what are the powers that they have? And I don't think there's really any project out there that, except for maybe Uniswap and probably Augur, that have kind of shifted as far to the end of the decentralized spectrum. I think most of them have something there which gives the protocol some level of power, or the project team. So I think it's something that we can definitely do better. I think that the trade-offs will get better over time as the tools kind of emerge and we have better tooling, and we'll be in a much better place hopefully in the next 6, 12, 18 months in terms of overall DeFi decentralization.
Well, it's like you said, it's a spectrum, right? And I think this is one of the most important things to realize about decentralization. It's not black and white. It's a spectrum, right? From more centralized to less centralized, right? Which we generally consider as decentralized, but there's all kinds of ways in which different parts of a business or of a crypto or of a network can be decentralized or more centralized based on different security needs and things like this. So very, very interesting. Now, I want to talk about something that I don't think is talked about enough in the crypto space, but that's cash flow, making the money, man, making the money. Because I feel like really only in 2019, there were some very, very few limited cases in 2022, really in 2019, and really now moving into 2020, we're actually seeing companies start to make money, right? Products have been delivered, products are functional, people are really starting to use those products. So I guess to speak a little bit on the idea of, the fundamental metrics of running a DeFi company and actually making it sustainable in the long run, and, balancing out those different stakeholders as well.
I mean, it's a hard problem, and we have definitely started to see protocols that are accruing value, right? But there's still some uncertainty around how that value accrual is happening, who's it accruing to, what are the implications of that, et cetera. So, one of the really interesting spaces I think at the moment is the DEX aggregation space. So you've got projects like DexAg and 1inch and Paraswap that are all trying to kind of aggregate this DEX volume, right, and creating these overlays. And some of them are free, some of them have fees, some of them have spreads that they charge, et cetera. And but they're all doing a lot of volume. They're capturing a lot of attention. They're attracting a lot of volume, and it's a really good user experience. If you use one of these DEX aggregators, you're going to get a much better price than if you just turn up to an exchange or Uniswap or whatever. And so you've got this really cool service that's being provided with different strategies for how you monetize it and different questions about how defensible those strategies are, et cetera. But we don't really have any good answers, right? So even recently, last week, DYDX announced that they're going to start charging fees protocol. So for the longest time, they didn't charge any fees, and they just kind of operated the protocol and tried to attract volume. And they've gotten to a point where they feel like, I think they've got a sustainable and defensible moat that they've built, and now they can start charging fees without necessarily losing that volume or having people go to a different venue, which is going to be really interesting to watch that play out, to see because there is this kind of I guess philosophical argument for, well, if you do that, if you start charging fees and you try and capture rent or whatever from this protocol you built, someone's just going to fork it and they're going to deploy it with zero fees, right? And I think what we've seen is that is a very theoretical view of the world, right? And branding matters, and security matters, and trust matters, and something like DYDX that's processed hundreds of millions of dollars worth of volume versus Kane's DYDX fork that I've just stood up over here probably is not going to have the same level of credibility in the market, right? And so I think that there is definitely an opportunity for something like DYDX that's built up a brand recognition and capture volume to charge fees and have it be sustainable. But there is certainly an element of the community that kind of is philosophically opposed to capturing fees or charging fees or anything like that. And so, Synthetix is a different case in that the fees are captured by token holders. So, still charge fees. There's a fee for the services that are provided. Stakers stake, and, people are able to trade on the exchange because of this service that is provided by SNX stakers, and the stakers get the fees from the transactions, right? So we've always captured fees. That's always kind of flowed to token holders, but we don't have a company that's accruing any value. If that makes sense, right? And so, again, different trade-offs, different set of network effects. But again, there's people who would argue, well, if Synthetix gets decent traction, then someone will just fork it and create a variant of it that doesn't have any fees at all, right? But we've kind of built the incentive structure in a way that shouldn't really be possible. But it's still, there is this kind of undercurrent of this idea of everything should be feeless, and it should all be just free software that's deployed to Ethereum and does stuff for people. So we'll see how it plays out over the next 6 months.
Yeah, I think there's personally, I think there's nothing wrong with having a business model that creates cash flow. It ensures sustainability over the long term. And I think we've seen so many different forks of ideas happen, and 9.5 times out of 10, let's say, they become totally irrelevant because they very quickly realize, wow, this is a lot of work to do all this and maintain all this and deal with the rent office space and pay devs and do all this stuff. You kind of need a cash flow for these things to make it successful in the long term. So I think it's good that companies are taking their cash flow concerns more seriously, because I think it really speaks to professionalization of the crypto space overall and the longevity that we're going to see for different projects like Synthetix and others in the space.
Yeah, 100% agree. You need a way to kind of sustain the protocol, and that it's about coordination, right? You need to coordinate these different participants in the ecosystem to do something that you want, right? And if you're providing a service and you're charging a fee for it, and that's sustainable, then great. So, hopefully we see more experimentation there for sure.
Nice. All right, I got two more questions left for you for today. So,
okay, all right, let's do it.
ETH 2.0. I feel like we've been waiting for this for a very, very long time. Very long time now. But it's coming, right? ETH 2.0 is coming. So are you worried about ETH 2.0? Are there any concerns that you have about the upgrade overall? And what are you excited about with ETH 2.0?
I mean, it's interesting as someone who's building on Ethereum now and very focused on the ETH1X kind of approach to things, I guess. My normal focus is more on Ethereum, as it stands now, than ETH 2.0. We are lucky that one of our audit partners is Sigma Prime, who's an Australian engineering company that is building one of the implementations of ETH 2.0. So we do talk to those guys. They're amazing guys. They do amazing work. But it's something that I guess as someone who's building right now today, it does sort of occupy this, it's over here, right? It's not something that we kind of worry about on our day-to-day. We're very focused on what we're doing, and the upcoming EIPs and things like that are being deployed onto the current Ethereum mainnet. So we've sort of taken we'll wait and see and wait for it to get here, but we're not necessarily in a rush for it to happen. But I think it is getting closer and closer. So it's obviously exciting. It's going to be a big transition. It's going to be a lot of work for everyone. But at the moment, we're just focused on the current implementation.
I like it. Deal with when it happens. Deal with what happens. Don't get too worried. It's at this point, I mean, at least 4 months away before we even see, phase 0, right? And it's going to probably be another, 18 months or so before it's 2 years before we even see the full thing roll out. So, we got some time. Sit back, relax. That's it.
Yeah. Keep accumulating ETH, right? So.
That's right. Keep accumulating ETH, which moves me on to my final question for today. So, do you think that Ethereum can outperform Bitcoin in the coming cycle?
Yes, I do. And we've historically seen the kind of the cycle is led by Bitcoin. Last cycle, debatable with how much ETH drove the cycle versus Bitcoin, and whether it was ICOs and all that stuff that was happening. This time there is a narrative of DeFi versus the halvening, et cetera, and which of those two narratives is going to kind of compete. My sense is that we are in a very different phase of crypto today than we were in 2017. In 2017, you had all these projects that were proposing great ideas, sometimes terrible ideas, but proposing a whole bunch of ideas without much substance to it. And there just wasn't much that was actually running on mainnet, right? Now you've got hundreds of different projects, all kinds of amazing wallets and interfaces and things that exist, and there's just so much you can do now. So the level of kind of traction that Ethereum has in terms of a platform that things are being built on top of is orders of magnitude higher than it's ever been, right? And yet the price is much lower than where it was historically. So I think we will see the market kind of catch up with that. That's going to happen, but it just takes a long time sometimes for these things to get adopted by the market. So
when I look around at where Ethereum is now, and I'm amazed by how many useful products there are, how many people are starting to use those useful products, people waking up more and more all the time that there's these decentralized exchanges I can go use, and I can go and trade synthetic assets on the Synthetix exchange, or I can get an NFT of a cat or something over here. There's all these different things happening. It's really, really exciting. It's really useful. There's so many boundaries being pushed right now, and there's more and more new products coming all the time, and it's almost all built on Ethereum. The network effect of it's crazy.
It's crazy. It really is crazy. And network effects are network effects for a reason, right? The tooling's much better than it was. The state of understanding of how to build things on Ethereum is increased massively. You've got things like Uniswap there that are kind of ready to be used. You can roll out a new token or some NFT or whatever it is that you're building. There's just much more infrastructure in place than there ever has been before, and it makes it that much easier for traction to be generated. So it's a pretty exciting time, but I think that we who are in the bubble, if you will, are much more aware of it than maybe people outside of it. Even within the wider crypto ecosystem. The Ethereum bubble is a small bubble, and I think eventually people will realize that all this traction has been generated, and there's going to be a lot of excitement. So it's going to take a little bit more time, but it's a pretty exciting time that we're in, I think.
Definitely is. Kane, thank you so much for coming on and talking about DeFi. It's very interesting chat. So hope everyone out there in the audience got a lot of value from it. And of course, there's a link down below if you guys want to check out Synthetix. Go over there and play with some synthetic assets, do some trading, all that fun stuff. So you can go check that out too. So Kane, thank you so much.
Thanks for having me. Appreciate it. It was good fun.
Thank you.
Thanks.